Hello everyone, welcome back to Business Hub. In today's class, we are going to continue from where we stopped on our previous modeling class, which is on the model style guide. In today's class, we are going to continue from the assumptions, as is the input, the drivers of the entire model. This is very important because everything we are going to be building is going to take effect from the input or the assumptions we make, and this is because the assumptions contain all the research or everything we know about the company and how the company operations are in the industry. So we are going to be building this model starting from the assumptions. So the assumption is going to give us the basics. It's going to be the building block of the entire model. Now, if you look at what we have here, I just went ahead to pre-format this in advance, but you can see that everything is simply basic things that we have done. This is just the formatting we did. I just applied those styles to all of this. So this is how we are going to be building our assumptions, and you can see how it is looking. Now let's start with this, explaining this one by one. Now if you look at here, this counter you're seeing here can also be called period. Now this counter is period. Remember, this model, we are building this model for a period of how many years? This model is for a period of 5 years. So let's put this as an input. So let's format this and put it in our input style. Input. What I pressed there was Alt HJ to give me this input style guide. So I'll go ahead and say what. Okay, this is the style I gave to this. So you can see. So once you apply the style, you can see that the model forecast period is 5 years. Right, so we are building the model for the period of 5 years. So when you come to your input here, the counter can also be called the period. You can either call it counter or you say period. So we come to this side, say, okay, what is our period? You're going to start by saying, okay, start, because you don't want to be inputting value one after the other. You can just say equals to +1. Now equals to the previous cell +1, so it will give you 1. When you put this, you can just fill it in. It will give you exactly 5 years. So let's go ahead and add our first style. I want to add our style. So this is an input value. It is going with input. This an input value is going with input. Now also have the inflation. Now inflation is also a very good driver, of course, because when you are looking at forecasting a model, like I said in the previous section, you are not in charge of the economy, so you don't know what is going to happen in the future. So you want to build this model today. As you're building this model today, you want to also assume that in future certain things will happen that you are not in control of, but you are taking precautions of those things in case they happen in the future. So that is what we're trying to do here. So we're going to go ahead and say, okay, if you look at our model here, the one we are taking precedent from, our base model that I have already built. So as at when this model was built, the inflation rate was 34.6%, but currently now I think the inflation rate in Nigeria is 24.23%. Yes, this is the current inflation rate in Nigeria now. So you can just go to your internet and browse it. So we have it to be 24.6%, right? So when you get that, what you're going to do next is you now come here. We say the inflation rate is what? We say the inflation rate is 24.23%, right? So another mistake you should avoid when building a model, you will not say, okay, because the inflation rate is already 23%, you will just go ahead and put 23% all through. No, that is not it. If you do it like that, your model is not going to be dynamically accurate, right? So you want to, one thing about modeling is when you're modeling for a business, you want a kind of reason. You say, okay, this thing you're doing, is it reasonable? You're trying to ask yourself questions, are this reasonable? Remember that models are built based on assumptions. We are assuming that this is how our business operation is going to look like, or this is how the industry operation is like, and this is how we want to, this is the path we want to take in the industry. So you're just trying to imagine and reason and say, okay, is it reasonable? You're asking yourself question, these assumptions you're making, are they reasonable? So a lot of thoughts, a lot of things, as you continue building model, you start asking yourself. There are some things that on a normal you cannot ask yourself, but when you start building model, you will understand that these are processes, these are things you need to have asked yourself in order to, or you to succeed in that business, right? Now, if you also look at it critically, you realize that the market condition you have yesterday and the one you are having today and the one you are going to have in the future is never going to be the same. And that is why you don't make this your inflation rate to be rigid, right? What I mean by rigid, you don't make it, you don't put it on a flat rate like that. So you have to also make it dynamic, let it change. It can either go up, it can either go down, something like that. Now, if you look at from what we have here, right? If you look at from what we have here, you see the inflation rate in Nigeria increased to 24.23% in March from 23.18% in February of 2025. Now, what it means is that the inflation rate increased in March, that is from 23.18% to 24.23%. So imagine if the economy is operating like this and your own model is rigid, is on a straight line basis, that the inflation rate is static, is like this. No, it's not going to make any sense. So that is why when you're building a model, you have to assume that certain conditions apply, certain things will change. Yeah, the economic condition for today may not be better, may be worse than the future, or the future economic condition may be worse than what you are having currently. So you just have to assume those things. But the best, I used to tell people that the best decision you're going to make in your business is when the economy is actually very bad, and you make those decisions and your business is able to survive those conditions, in those harsh economic conditions. Your business survive those harsh economic conditions with those decisions, and then the business is going to thrive, right? The business is going to thrive. So that is why if you're building a model, you have to make everything reasonable. You have to just reason like the economy, follow the pattern of the operation. One, government may come up with a kind of policy that affects the entire operation of the industry, and it will also affect your business. Imagine if you do not take precaution of all these things in advance, it will become a problem to your business and you may run out of business, right? So that is why you don't make them rigid. So since the current inflation rate is 24.23%, we're going to say, okay, the next period, normally inflations are projected annually. What it means is that if you look at this 23%, you will divide it by 12 to have the monthly inflation rate. But because this, we are just building a model entirely, we can just go ahead and use this percentage. It's not a problem, it's a model, right? It's a model, it's also going to help us, right? So but when we, and because this model is actually going, is yearly, yeah, the model is an annual model. But when, if we are building this model for on a monthly basis, we will find a way around it, and we are going to make sure that we incorporate the inflation rate, the economic conditions in every model we are building. So these are things you have to take caution of, right? If you look at here now, if you go to the next year, let's say 2026, what you want to say, okay, I want to say, okay, in 2026, since we have 24.23%, 24.23% inflation rate in 2025. In 2026, we are assuming that the inflation rate can either go up to 25%, or it can go down, right? So let's leave it in 25. Let's say the inflation is going up by 25% in 2026. Now in 2027, we also want to assume, okay, all right, let me just go back to what we have here. If you look at here, these are the projections these people make. Since we are using their projections, we're going to go ahead and say, okay, they assume that in March, which is this one, the current year, the current period, the inflation is 24.23%. Now, in they're assuming that within this March to June, the inflation will come down to 20.50%, right? Now, what we are going to say on our own, we can say, okay, if that is their projection, our own will say, okay, that means the inflation remain consistent, that it remain constant within this period till June. That we are going to say, okay, our own inflation rate at this point, because we are modeling, we are building a model, is 25%. Then when we come to the third year, we can say, okay, the economy got better again and reversed back to, let's say, 24 point let's say 24.50%. And in the fourth and fifth year, we say, okay, the economy actually got better again at this stage. I say it got better again, and we are at 20. What? Let's use what they have here. Let's just use what they have. They have 20.5 and they have 18. So let's say the economy got better. We have 20.5% here. I have 20.5% here. This is an assumption. Remember, that's model. So you can see with this now, your model is a little bit dynamic. You can see how the pattern is going. Now, when you start operations and you start getting real data, you will now start updating your model accordingly. So that is how to build a model, and that is how to take care of the inflation rate. But notice, we don't say because we have the inflation rate to be 20%, this percentage, that's 24.3%, we are going to apply it directly. What we are going to be applying, what we are going to be using for our calculations is going to be on the inflation index, which is what we're going to calculate, right? So it's going to be on the inflation index. So what we are going to do right now, first, let's first of all give this our style. So if select it, Alt HJ, then percentage. All right, so this is our percentage, and we are going to give it our inputs style. Now we can go back and give it a percentage. Why? It has to be on our input. Modify this percentage and remove this. Okay, so input percentage, so that it should take the same color. It's an input value. It should not be it should not take the hard-coded color. So it's an input. So we have this, and now we are going to calculate our inflation index. Now the inflation index is what we are going to be using to do our calculations. Now the percentage, the inflation rate, is just a basis for us to have the percentage, but we are not going to use the inflation rate to do our calculation. What we are going to, you are going to use a portion of that inflation rate, which is the inflation index. So how do we calculate our inflation index, right? So we can just say equal to 1 equals to open bracket 1 plus the inflation rate, close bracket, raised to the power of open bracket 1 minus the counter, which is the period, minus the counter, and you close the bracket. This is what you have. Now this now is going to be our inflation there, and we are going to put this in our multiple style, right? Multiple style. Sorry, there's a mistake here. Is this at this point, this is not, this is going to be, let me repeat it again. We have open bracket 1 plus the inflation rate, close the bracket, raised to the power of open bracket the counter, which is a period, minus 1, close the bracket, and enter. So that is what we have. Now if we do that, we are going to apply our multiple style here. So select this and fill it in, Control R, then we apply our multiple style. Alt HJ, we have this option. So we have our multiple, this is our multiple, so this is it. You can see this is what we have as our multiple, right? So this is what we are going to be applying on our cost. Remember, inflation is on cost, while price index is on revenue, right? Price index is on revenue, while inflation index is on cost of items, or cost of the things or services we offer. So this is it. Now we have calculated our inflation index. The next thing is what? Our growth rate. Now when we talk about growth rate, right? We are talking about how do you think your business will grow? At this point, sometimes we leave the client to decide how he intend to see his growth, the benchmark, or how he wants to grow. So we intend to leave it with the client to do that. But because we are modeling, we don't want to leave this. We don't want to leave any stone unturned. So we want to just make sure that we build everything, but everything should be dynamic, so that even when the client makes changes, it will not cost us the same amount of time it took us to build this model from scratch. So we just have to take it from there and you just make some changes and everything updates automatically, right? So that is what we are going to be doing. So sometimes we allow the client to make these decisions, but in this case, as a modeler, what you are expected to do is to decide on your own and say, okay, this is what I assume the growth rate will be. So the growth rate, the pricing growth rate for this product, we can say, okay, our pricing will increase by so percent. So let's take for instance, what do we have here in our base? Now, if you see here, the pricing growth rate we assume here is 35%, right? Which is very, very high. And sometimes I do this because of the inflation rate also here. So if you use any value that is lower or is lower than this, you actually be seeing loss in your financial statement. Let's take for instance the pricing growth rate is let's say is 2%, right? If you come to the income statement, now this is what I'm talking about, right? Now the inflation rate is 34%, right here. Here now the inflation rate is 30. This is our base financial model, the one we have already prepared initially. So I'm using this one to teach us how to build something like this too. So this is the inflation rate, and this is also this is the pricing model. Now this is an assumption. Everything assumption. You are trying to ask yourself a question. Modeling is all about asking questions. Is this thing you are assuming reasonable? The inflation rate is 34%. Of course, the pricing growth rate should not be something um should not be lower than the inflation rate. Why? Because inflation has to do with cost, and the cost, we transfer the cost of everything, the burden of cost to our customer. So if inflation rate is increasing, definitely the prices of goods and services will also be increasing. So that is why sometimes I try to make sure that I build this model in a way that not necessarily to present the business in a light that it is a profitable business, but at least trying to follow the pattern, or trying to follow the pattern or the trend in the economy. So that is what I'm trying to do here. Remember that different modelers have different approach to this. So it doesn't matter whether my approach is wrong or his or another modeler's approach is wrong. Everybody is trying to think. You're assuming that okay, this will happen in the future, and if this happens, this is the kind of precautions you want to take, right? So that is what we want to say. Now some people will say that, some people may say they want to, if the price of if the inflation rate increase, they'll say okay, they add a certain percentage. They may say okay, if the price of if the inflation rate is 34%, then we want to say okay, the inflation rate plus, let's say, 2%, right? Let's say the inflation rate plus 2% of that. So when you now, okay, it's percentage, so we are going to incorporate the growth rate. We are going to use a growth rate in that. So some people may say okay, you add a certain percentage to this, which is exactly what I did here. What if the pricing growth rate is lower than the inflation rate? This is what will happen. Now let's say we are using 2% here as a increase, that the price will increase by 2% each year. Or so if you now fill this entire model like this to this, you can see that everything changes here. So come to your financial statement. You can see that okay, the business was actually doing well. So here you can see that the net profit margin in the first year was 43%. Then it came down to 40%, came down to 25%. You can see how the thing is going down. What it means is that our cost is increasing while our revenue is actually dropping. So that is what it means. Now if you look at this is our revenue in the first year, this is the second year, this is the third year. Now look at our gross revenue. Now if you look at our gross revenue in the first year, even though we made higher sales in this period, but look at it, look at our gross profit. Gross profit is showing that our costs actually increased, which means our inflation rate is going higher. And because of that, we if we continue in that light, you can see that if we continue increasing our pricing rate by 2% annually, we are going to make loss if we continue at that rate. So that is what you are seeing here. You can see that the fourth and the fifth year here we have lost, which is very, very bad. And this is what the problems that models are trying to answer. This is a problem that a modeler is trying to answer in case this happens. Now you have seen that this is where this business is going, and if this is the case, then what should we do? And this is what some businesses have not understood, and that is why they end up going out of operations. So if you understand the dynamics in the economy, how the economy is operating, or how the trends in the economies are, then you can be able to model your business to follow the same pattern, right? So you can see this is a typical example of that. Now when we come back to our own model here, we can say, okay, because the inflation rate is at 22%, 23%, I want to assume that the growth rate, right? The growth rate the growth rate is going to be, let's say at 24%, right? I can just decide to fill it in automatically. I can just give it a flat rate. That's what I mean. I can just give it a flat rate and everything will be like that. It doesn't matter because the owner of the model is the one to decide it. So you are just doing this so to enable you build your model complete, right? You don't want to leave any stone unturned. That is why you want to at least have this amount, this percent, that this is the pricing growth rate annually. Right? So that is what we are going to be doing. So if we come back, since we have imputed this, apply our sales style. So alt hj, then is going to be input, then alt hj again. We are now going to say it's a percentage, right? Always make sure that this, because this is the same rate, I can decide to just do it at once, right? So this is it. Now we have gotten our pricing growth rate. Now the same thing we did on the inflation index, exactly the same thing we're going to do on the pricing index. Now we're going to get the pricing index, which is what we're going to be using to multiply our prices, right? So you can just come and say equal to, if you did not get the earlier the one I did on the inflation index, this is another place where you need to pay attention. Equal to, open bracket, 1 plus the growth rate, the pricing growth rate, close bracket, raised to the power of, open bracket, the counter, which is the period, minus 1, and close the bracket. Then you enter. When you enter, we're going to apply our cell style, multiple cell style. Then you fill this, Control R. So this is what we have, right? This is what we have. Now you can see that with this we have, if you're looking at the pricing index, now you can see that, okay, this and this is the same. This at least increased by, this came down by this because this percentage is this. Now you can see how the model is, even though it is not reflecting what we let's say what we projected or what we may want, but at least in the fourth year, in the fourth and the fifth year, we are seeing significant change, right? We are seeing significant. So model is trying to answer those questions, that in case things happen in the future, how do we want to mitigate this? That is why we are building model. That's the essence of modeling. You are trying to model and say, okay, economy is not going to be stable, it's not going to be stable, or it's not going to be, let's say, the way it was yesterday is not going to be the same today, right? So that is why you're trying to take precaution of these things, right? So if you look at this, we have now we have modeled our pricing growth rate, and also model our pricing. We have calculated our pricing index, which is what we are going to be using to do our calculations, right? Now, the next one we want to say, okay, the business growth rate. Now, when it comes to the business growth rate, we are now looking at the industry as a whole. We're looking at the industry as a whole. Remember that the model we are building is is a logistic company model, right? So we are trying to ask ourselves, we're trying to say, how is the industry like? Because before you venture into any business, you might have done your research, you might have done your homework and know that, okay, this is how the industry operates and this is the trend in the industry currently. So that is what we are trying to ask ourselves. So I will just go ahead and continue with the growth rate which we have done. We assume here, we assume that we, according to our research, based on when this model was prepared, it was the industry is growing at the rate of 6.7%, right? The industry is growing at the rate of 6.7%. So we are going to use that 6.7%, right? So let's go ahead and say 6.7%. That is, the industry is growing at the rate of 6.7%, and we are going to put it flat. Now, there are some there are some key places where you don't need to make everything, let's say, like I say, when it comes to the economy, you don't have control over it. You just have to follow the trend, and those data you're looking at on the internet are actually provided by researchers, people like you and I, who have a data warehouse where they get all this information and they analyze it and um, post it on their different blogs or different websites, like the one we have on the inflation rate, right? So you just get them and input them. Or another place you can get is, if you're in Nigeria, you go to your Bureau of Statistics, you can get the data regarding these industries and how they operate, right? So that is how another way to get this information. Now, since we are taking that the industry is growing at the rate of 6.7% annually, we can just make it a flat rate. You can decide to also make it dynamic, increase in some years and decrease in some years, something like that. But here we are just leaving it, we leave it on a flat rate basis. So I'll come here now, I'll copy this. Let me, because I don't want to go through that stress. I'll just copy this and paste the format in here. Alt HV S T, then okay, right? Because it's the same percentage. Right, so this is what we have. So we have assumed that this is now the industry growth rate. Now let's go down. Now the next thing we have is the government. Of course, this you cannot do without. So you have to pay your taxes. You cannot be making profit and you will not be paying taxes, because those amenities provided by the government, they use taxes paid by corporations and individuals to provide them. So you have to pay taxes for them. So you have to make provision for tax. So our provision for tax is going, some people, sometimes some modelers make sometimes decide to make it higher. Like in Nigeria, our corporate tax is 30%, right? The corporate tax in Nigeria is, that's company income tax, is 30%, a flat rate. Just copy this. This is our tax. This is just simple. You know the tax rate in your country, you know the tax rate in your state, wherever you're watching from. So that is it. Now the next one is assets. Now this is also very important. Assets are the resources we use in generating revenue for the business. Now, what we are saying is that if we have this asset, how many years do we think that the asset we have is going to last? How many years, right? How many years? So in this case, let's say we have a set of asset, property, plant, and equipment, a set of asset, and this asset are expected to last for 5 years, right? So like what we did here, this asset are supposed to last for a set of 5 years. So we're going to now say this is our asset useful life. Now we also have what is called asset maintenance. Yes, asset maintenance. Remember that when you buy an asset, let's say for instance, you bought a car, right? You bought a car. For the first day you are using that car, you may not experience any problem. Of course, if you experience any problem in the first year, you have a warranty from the company that you should return the car or something like that. So, but it is expected that when you buy that car for the first year, that car should not give you problem. That car should be able to function optimally, should be able to function without giving you stress. But as you continue using the car, as you continue using the car every day, now the car depreciates, right? The car depreciates. And remember that as you're using that car, as it's depreciating, whether the car spoil or the car did not spoil, it's also generating revenue for you. Now, if the car is generating revenue for you, that means there is a value that the car there is a value that is going out of the car, which is now the depreciation. Now, how do we handle that? No, to make provision for the money, or to make provision for those resources, or or at some point where you will be making repairs or you'll be making maintenance. Remember I said that in the first year, the car is not supposed to give you much problem. All you need to be doing is to refuel. When the fuel finish, you refuel. If it's an electric car, you recharge, right? But in the first year, you shouldn't have any issue. So that means from the second year now, you should be able to say, okay, your car will start developing some issues. So you start repairing, you start replacing some parts. So how do you handle that? That is where the maintenance, asset maintenance comes in. So the asset maintenance is trying to make provisions for the things that may happen to the car in the future, right? Because you're using the car, it means that the car is being used to generate revenue for you. That means you need to make provisions for maintenance of that car so that it can continue generating those revenue for you. So that's just the simple thing I want you to understand on asset maintenance. And this place, we don't do much calculation. You can see what we have here. We just have it basic and simple. I will just, let's say, copy this. Sorry, I'm lazy. Don't be lazy like me. You have to do yours, right? So I'll just paste it as a value, right? So this is it. This is, now I decided to use 0 because in the first year, like I said, the first year the car is not expected to give me any issues. But in the second year, we are trying to say, okay, this percentage or this value, this amount should also be made, this provision should be made for the car. So when you come here, you can decide to put the year here or you put the year here. So this asset is going to be used, let's say, for 5 years, because we are building the model for 5 years. The asset is going to be used, let's say, for 5 years, right? So this is an input. Go to Alt HJ and input sales type. Then here too is an input, Alt HJ. Then we can now apply the multiple sales type. The multiple sales type, I think we need to arrange, reformat the multiple sales type, modify the multiple sales type, remove the font, and okay. So this input or HJ, sorry, or HJ, then we have the multiple sales type, right? So this is it. Now this is what we have. So our basic economic assumptions or general economic assumptions have been laid out, right? We started from the timing, which is now the counter, the period, the counter or the period. Then we did research on the inflation rate. We now calculate our inflation index and the pricing growth rate. We calculated our pricing index, and now did research again on the business growth rate. That's the industry growth rate. You can see business growth rate or industry growth rate. Industry growth rate, right? So we say the industry growth is growing at the rate of 6.7%. Now we have the tax, and finally we have our asset maintenance, right? So now that is that. The next part is going to be our funding side, right? This is our funding. Remember, what we are doing here is assumptions. That is, we are building our assumption table. right? We are building our assumption table. So let me just freeze this site. I mean, view, then freeze. Oh no, I don't want the freeze to be here. Let's say I want to freeze it from here. Freeze, right? And let me do something quickly here too. This is a forecast period. Let me just format it and put forecast or estimate. You can decide to use F or use F for estimate. So control 1, custom, click this, then 0, put 0. 0 means it's that the first thing there should be a value. Then any other thing that follows is going to be, let's say, an alphabet, a letter, right? So once you do that, you put this. So you can see that it has appeared in front of the year, right? So just go ahead and click OK. As you can see, everything has been applied, right? Then this is going to take the explanatory cell style, this too. So the whole of these two will take the explanatory cell style. Go ahead and do that. So have this, right? So we have this and it looks more cleaner and more attractive. So this is our model. So when you scroll, the essence of the freezing was so that if I scroll, I can be seeing what is on top, right? So you can see as I'm scrolling, I'm still seeing what is on top. Now we have the funding side. Now, how do we intend to get money for this business? Right? How do we intend to get money for this business? So we intend to get money for this business. We can say either from equity financiers or either from by obtaining loan, right? So let's say we are obtaining loan. We are obtaining loan. So how much money do we need? Remember that before you start building a model, the client must have told you what and what. You must have sent a questionnaire to the client, and the client will have shown you or fill that questionnaire for you. And in that questionnaire, you have all the details you need. He needs so amount as a loan, and needs so amount as equity, right? So let's say from what we have here, from what we have here, the client is looking at 5 million naira and 15 million naira, a total funding of 20 million naira. So he's trying to say, okay, equity should be, his equity in the business should be is 15 million naira and his debt is 5 million naira. Sometimes reverse is the case, right? Sometimes people obtain more loan than the equity, right? So depending on the company's choice, the client's choice, this is how we are going to do it. So once you have this, you just do something, copy this. Don't be lazy like me that I said you have to type. So let's say this is what we have. This is what we have, right? This is what the clients want, right? So let me see if the style is the same. Right, this is what the client want. The client is saying that I need this amount. This is what I want. I need 5 million naira as a loan, and I also need I have 15 million naira as equity. So the equity can be that he has the money in cash or in his bank, or that he has a pool of friends who pool money together, or they are doing the business is a corporate organization, of course, the corporate firm, and they pool their resources together to get the equity funding, equity amount they are using, the amount they're using to start off the business like this. So you can just do that. So select this total funding and let's give it our total sales style, which is this, and then sum these odds equals to have this value. So let me go ahead. I noticed earlier I knew I was going to increase this odds HOW, then I can just say 20, right? So this is it. So 20, so we have 20 million naira. So that is just it about the funding. Remember, everything here is assumption. We have not started calculation yet until we build our assumptions first before we can decide, before we can start our calculations. Now, since we have gotten this, now On the part of the cost of financing, which is the cost of loan, or the cost of loan. Now, if these people are, if this person is providing this loan to you, how much interest do you want to pay him, and for how long will the loan last? Right? For how long will the loan last? What is the duration? What is the tenure of that loan? Now you can see we say the tenure of the loan here is 5 years, and we have the interest rate to be 25 and 23%. Now this is another thing you can do. Now, if you are building a model, the client may not know the current interest rate. Now, current interest, how where will you find the current, excuse me, where will you find the current interest rate? You can go online and search the country where your what is their current interest rate, and this is usually found in Nigeria. Is usually found, it is usually published by the central bank, right? That's where you can find this information. The current interest rate at that point is what? So here we have it to be 23%, which is what we are still going to be using, right? We have it to 23%, and the interest and the loan period is 5 years. The loan period is 5 years. The loan period is 5 years. And paste this here, and we can just give it our style. This is our input style, then change this to percentage style, right? So this is what we have. This is what we have. So that means on the loan they obtain, they will have to pay, 5%, they have to pay 23%. Let's just make this 25%. Let's say they will pay 25% interest on this, and the loan is duration is for 5 years. That within these 5 years they should be able to repay the entire amount they borrow plus the interest. Right? Now, on the part of cost of financing, again under the equity, right? So remember that nobody is coming in to do business with you that don't expect something in return. The reason why you are going into business is because you need to make profit. Yes, the primary aim of every business is to make profit, right? So when you are going into this business, if you're asking people to give you their money to use and run or start a business, what are you giving them in return? That is what we are trying to answer under the equity section. Now, under the equity section, that is what we're trying to ask. Right now, let's say if your business makes profit, how many percentage of those profits or the profit is going to be for your equity holders? That's your shareholders, right? So that is what we're trying to answer when we say dividend payout ratio, right? Dividend payout ratio. That's what we're trying to answer. So if you look at the percentage we use here, we are using 30%, right? We are using 30%. Now we are saying that out of the profit we make, 30% of that profit is going back to the investors, which are the shareholders. 30%. So what you're going to do is just type 30% here. 30%. So that is just the simple definition of the dividend payout ratio, and that's the reason behind it. So if I am investing with you, how many percent are you giving me as an interest? And yes, as an interest, as a profit. How many percent are you giving me? That means I own 30% of whatever the business make at the end of the period. Now on the part of the discounting rate, we are going to leave that when we come to valuation. That's after we have built the entire model, right? We are going to come back to the discount rate, right? So that is it on the part of our funding. Now, after obtaining this money, how do we use them? After we have obtained this money, how do you use them? So that is one question we want to know. Every investor will want to know what you're going to use the money you are asking for from him, what you are going to use the money for. So that is what we are going to answer right now. So if you look at our base model here, these are the things we are going to use that money for. So I'll just go ahead and copy everything here apart from the working capital. because I'm going to show you how to calculate that or how to get that value, right? So let's go ahead and say, okay, this is what we have. We can just paste, right? So this is the value we have. So you can see we have this value here right now. So let's go ahead and apply our formatting called HJ input, right? Input. You can see now this is our formatting. We are saying that our for business registration we are going to, it's going to cost us 50,000 for business registration, business licensing, and professional fee. What again? Professional fee, research and development, research and development, research and development, right? This is what it's going to cost us for research and development. This is an assumption. This is just an assumption of what we want to use the money for, right? So we have this, the business asset. Now on the part of the business asset, we are saying that okay, this is what we are going to use the asset. We have this furniture and fitting, which is going to be used in the office. Now we have the property, plant and equipment. Property, property, plant and equipment. So this is what we have. Now under the property, plant and equipment, we have still under business asset. Under property, plant and equipment, what we want to use the money to buy, we want to buy 5 motorbikes, right? 5 motorbikes. Remember, it's a logistics company, it's a delivering company. I want to buy 5 motorbikes, and it's going to cost us this amount. That's 10 million naira for those 5 bikes. And we also want to have a website and a routing software that's going to cost us 350,000, and we'll have to get an accounting application software, which is now we have chosen QuickBooks. Accounting should be one of the applications we are going to use, right? So you can see that this is how we are breaking down how we are going to use the money we obtain from our investors. That's from equity financiers and our debt financiers, right? Then we have the business stocks. Now these are the business stock. What's the value of the business stock we want to have in stock? We have this. We want 2.5 million naira, and for awareness we have this amount, which is going to be for marketing and PR as publication. Now this is very important. Before you even start any business at all, you must have started, you will even start incurring expenses ahead of the business even before you start. One, for instance, you start creating awareness. Try telling people that okay, I am starting this business, so in so period the business is going to come into life, and this is what I do, so patronize me. So those things, those places you are going, those people you are meeting is costing you money, at least for transport. If you're running ads, it's going to cost you money for the billboards, or it's going to cost you money if you're running a social media ad. So all these things are money that is going to cost. So you're trying to say okay, before this is what we are going to be spent, this is what we are going to spend. Now that when we get that, then we have what is called pre-operational cost. Pre-operational cost, even though the awareness too can fall under the pre-operational cost, but let me just limit it to what we have under the pre-operational cost here. Now the pre-operational cost is the sense that the things you need, because those things are important, the things you need and you know that you're going to spend them. Now for instance, if you look at rent, of course you need an office space. So even before your business start, you must first of all pay the rent. It doesn't matter when you start operating in that office, but you have to pay the rent for the office space you're using, right? So this is what we have. We have this as our yearly rental fee at 3 million naira. They will also have insurance. You have to pay for insurance, to make provision for insurance. Then we have the working cash. Working cash is the difference between the total funding and everything you have spent from them, everything you have spent to bring the business to life, right? So let's format this. Smart, this gives our total sales style. Control Alt, sorry, Alt HJ, total sales style. Then this is the summation. Now we first of all sum everything here, everything, everything here. Now if you sum everything here, you can see this is the value we have. Now what we are going to do is for us to get our balance, remember the total use of fund. This is our total use of fund. We want everything, the total use of fund, we want everything to be, what is our working cash? Our working cash is that after we have spent everything we spend, how much is remaining for us as cash? Remember I said cash is king in every business. So you must always have a certain amount of money with you so that you can settle your immediate business needs, right? Your business may be making a profit, but if you don't have cash, you run out of operation. Let's say you need to settle your vendors. Of course, if you don't have cash, what will you use in settling them? So cash is actually king. So when you want to do any business decision, you must always consider the cash at hand, right? Cash at hand. So what is now our working cash? The cash you're going to be using for operation. That's for day-to-day running of the business. Now, for us to get that, we can say equal to. Now, when we say equal to, we come here, this, then we say minus, then summation of everything we have here. Summation of everything we have here to the insurance, and you close it, then you enter. You can see once you do that, we have this amount of cash, right? We have this amount of cash, and everything checks out to the total use of fund that we have, right? Total use of fund, that's the total funding we have here, right? Total use of fund, that's it. So this working capital, since it's calculation, I can just decide to apply the calculation style. I think we have it. This is our calculation style, right? This is our calculation style. Now this is just it. So you can see how our model is coming into place. So if you're able to build your model in this order, it becomes easy for you. It becomes easy, very much easy, right? It becomes very much easy for you. Now when you look at it again, we see that we have what is called operational total pre-operational cost. Total pre-operational cost. Now the reason why I like bringing this here, even though it doesn't make it much sense here, but I don't like, sorry, I just want to add one. So the reason why I like bringing this one here is because, how will I explain this? When we start the calculations, I don't like a situation whereby I will have to come back and start selecting this one by one, and no. So I will show you when we start the calculation, but for now let's just calculate. Let's get our total pre-operational cost. So our total pre-operational cost is going to be equal to equals to everything we have under the business development, right? Equal to sum everything we have under the business development, comma, then everything we have from the awareness to to the pre-operational cost. Some modelers may decide to exclude the pre-operational cost and only take the awareness, but I like including it because it's cost. These are things money I spend ahead. These are money a business spend ahead, right? So it also forms part of the total pre-operational cost, right? So let's go ahead and click OK. Now I can also give reason as to why some people don't include rent in the pre-operational cost, right? Some will say because the rent is not something they consume immediately. The rent can be used for the across the whole year. I can understand why some people that the same thing with the insurance. I can also understand why some modelers do that. But me, I want to get my total pre-operational cost. So I assume that my total pre-operational cost is going to be the total of this. So depending on the choice, depending on the modular, it's your choice now to decide which one actually suits you. But I like getting these figures the way I am doing it right now. I get the total business development cost, and I also get the awareness cost and the pre-operational cost, right? When I do my calculation. So this is my pre-operational cost. This can just be, let's say, total sales. Just leave it like that. It doesn't matter. We are not actually using it for anything here, but I just want to click it once, not to go back and start calculating it again, right? So let's go ahead. Now if you look at here, we have our operations. Now this is where the entire business lies, under operations. So format this, give it your sales style, which is going to be heading 1, right? Then this is going to be heading 2, revenue and cost heading 2. Now operations, from the word operations, already you already know what operations mean. So let's say our revenue drivers. So what is our revenue drivers, right? So our revenue drivers are the things that actually brings in money to the business. What is our revenue drivers or revenue stream? You can call it revenue drivers or revenue streams, right? So our revenue drivers is, because it's a logistic company, we say, okay, this is our freight delivering fee, right? This freight delivering fee, and we charge per kilometer covered, per distance, right, covered. So that's how we charge here. Now if you look at what we have here on our base model, now we have that we assume that the business say is charging 500 naira per 20 kilometer distance, right? Per 20 kilometer distance. So that is what they charge for it. Now we also have the last minute delivery. Now last minute delivery is just like door to door delivery, right? Delivering door to door or office to office. That's just what last mile delivery means. So we have the warehousing, that's warehousing and storage facilities. Now if the business provides, we assume that the business is providing warehousing facilities too for some of their parcel, also some product they ship, maybe the client ship them back and ship them to their warehouse, and this is what they charge, right? So they charge this. Then we have other added values. Now we have other added value services like packaging and all those stuff. These are where they comes in. So this is the revenue stream for those for the company. You can just go ahead and copy this. As I'm copying the whole of this. Okay, let me just use this place to explain everything, then we can take it to our model. Now when you look at it here, this is what they do, and you see that this is their variable cost, that's their cost associated. So you say for every distance cover we have, for every 20 kilometer discount cover, we have this. We have dispatch riders. Now they are not paying, we are assuming that they are not paying their dispatch riders on salary basis. We assume that they are paying their salary and their dispatch riders on wage basis, and that is why it's coming under the cost of sales, right? In some instance, if it is based on salary, you can take them to, some people may decide to take them under admin or HR, under admin operations, right? But here we assume that they are, dispatch riders are paid based on how many deliveries they make, right? So that's how we are building, that's what the assumptions we are building here. Then we have the packaging and handling, that's other value added services cost. We have this is what it costs us. Now we also have the quantities like distance covered. Now this is actually very important, because this is going to tell us that, okay, we are assuming that for the first month, or for the first month, we are assuming that we are going to be covering the total quantity of free delivery, and everything we did is going to be 500. Going to be 500 deliveries. We have 500 deliveries for free deliveries, just delivering once. Then we have the door-to-door delivery 500. We have warehousing facility 500, and we have packaging and handling 500. So these are just like a quantity of the items or the volume of services. You can say quantity or volume, I think volume is going to be more appreciated in this volume. So volume of service we have rendered, this is the volume, right? So you can see how this projection is. Now this is how we are going to do it. So let's just go ahead and copy this. Yes, don't be lazy like me. You will have to type. Like I say, you just have to type, right? And also, let me just make something clear. I won't be providing this file because I realize that some students are very funny. When you provide a file, I have seen a student who, after I have provided this file for free on my channel, and the student went ahead to be selling it to others, right? And it's actually very bad. So I won't be providing this file per se, but if you need this file, just chat me up, drop a comment, and I'll reach back at you. Then I may send it privately to you, but please, if I am sending it to you, just use it for the purpose of the training. So this is it. These are the values. We have pasted them here. Why you are having this D behind is because I formatted it to have this D, which means distance. This is just like a distance, just an indicator. It does not mean anything actually, just an indicator for me, right? So this is it. So apply our cell style, right? So when we apply our cell style, we have this. So this again, I can go back and just put the distance, control 1, go to custom, and just click here because it's already in the system. It's already there. I copied and pasted. That's why we're having it like that. So we have this. So we have this. Now these are the things we have. So we can go ahead and adjust this one bit, so we can go ahead. We have something of this nature, right? So we can still go ahead and say, why is this so far away? Let's try to align this. Okay. All right. So you can see we have it like that. So we have this. So you can see these the assumptions we have built on our revenue and cost. So we have this our revenue. So let's just format this and put it. So we made change here. We say this is quantity slash volume, volume of delivery, volume of warehousing, packaging. That's what it means. So this is the assumption we are making. We are saying that the free charges is going to be 500 per every 20-kilometer distance covered, right? And that is what applies to these two. The warehousing charge, we charge this per square feet, per square meter, per day, depending on how we decide to do that, right? So that is what we are going to do. Now we have these two. Now we have the total discount, the total distance covered, sorry, the volume of delivery we have made. So we are assuming 500 delivery we are going to be making 500 delivery every month. That is what we have here. Now, after that, we have our selling, general and admin expenses. Selling, general and admin expenses. This is heading 2. Now on the HR we have the manager, and under the manager we have the sales personnel, and we have the accountant, we have the dispatch rider. Now I included this dispatch rider here because I just want to show us something, right? This dispatch rider, because remember we have 5 bikes, so that means we are going to have 5 we are going to have 5 dispatch riders. So the head count is going to be the number of staffs we are going to have in each of these departments. The number of so we are going to now say here, we say that under this we are going to have 1 manager, and we're going to have 1 sales personnel, we're going to have 1 accountant, we are going to have 5 dispatch riders in the first year. Of course, this is also a mistake. I think it's a mistake. Of course, this should increase, right? 5 dispatch riders, and it's going to affect something. Definitely it's going to affect something, but it's not a big deal. So but it's supposed to be five. So we're going to have five dispatch rider, and of course, as the business is growing, we are going to increase our capacity too. We're going to have these people. Now, I want to be lazy, like I told you. I want to be lazy. So I'll just go ahead and copy this. Go ahead and copy this and come to our model here. Our model here, then I will paste it as value, right? So this is it. We want to have one manager, one sales personnel, one accountant, five dispatch riders across the entire 5 years. But as time goes on, as we continue doing business, because the business is going to be profitable and we're going to keep increasing our values, right? So that is what we have here. Then we have this much, and then we have other staffs. Other staff could be security, could be drivers, could be maybe drivers of some personal drivers, right? So that is it. Now, the HR, how much are we paying these people as salary? That's what we're trying to answer here. So we are going to say, here we are saying that we are going to be paying the manager this amount every month. We're going to pay this salesperson this, and we're going to pay this person 250, and then this person 50,000. So let's go ahead and format this. You can format all of them at once because they are all the same style. Just format Alt HJ, Alt HJ, then put it as input style. So this is our input style. Remember what I said about the blue color? The blue color is a unique color for modeling when you are hard coding values. So it will differentiate your values from, you can say, okay, these values you are seeing in blue are values that are typed. They are manually typed into the system, or they were linked from another place to this sheet, right? So that is what we are trying to say here. That is why the color have to stand out, and doing it like this makes your work look more neat and makes it look more consistent, right? So we have this. You said that the manager is going to be getting this as his monthly salary, the personnel as 70,000 as his accountant, and so on and so forth. So other staff, other operations, other cost, operational costs. So other operational costs, we have the rent. So now this is where we're going to we will break the rent down. Remember that the rent value is how much? The rent amount is 3 million naira here. So this is where we're going to be breaking the loan amount. We are going to be breaking it down into monthly, right? So every month, what we are paying every month is what? What you're paying every month is 80,000, is 250,000. So if you multiply 250,000 by 12, it should be able to give you, it should give you 300,000. Let's see. It's give you 3 million naira, I mean. 250 times 12. You can see 250 times 12 is giving you. So we are now charging it monthly on our model, right? So you can see we are taking care of it. Now we have repairs and maintenance. We are assuming that our repairs and maintenance is going to be 100,000 naira on a flat rate, right? Just an assumption. It may not reach, it may not be up to that, or it may be even higher than that. But it's just an assumption. And we're saying that our utility fee is going to be 20,000 naira monthly, and we have 50,000 naira as our internet cost. That's for data and other stuff. Then we have our marketing cost. Marketing cost is also going to be, let's say, 50,000 naira monthly. And we have this, of course, this marketing, as the business keep growing, they either for the first 3 years the marketing price, the marketing cost will increase. As people become aware of the business, our marketing costs tend to, we have to reduce, because people are now being the one recommending our business because of the value we have created as we, for the time we have been in existence. So as we grow our businesses, as we grow, our marketing cost also reduces, right? So we have the insurance, which we have seen. Then we have other expenses, right? So this is our other expenses, and now we have done the assumption on the selling SG and A is now complete. So the next thing we are going to be looking at is how to get our working capital assumptions. Now, our working capital assumption, that's what we're going to do now. So let's format this. So assets. Now, remember when I said cash is king, right? So cash is king in the sense that you always need money. You always need money to be running the affairs of your business. Let's say for instance the car you purchased, the car example we are using. So the car broke down somewhere and you're supposed to repair that car. You call the mechanic to come and repair the car. The mechanic came and finished repairing the car, but you were unable to pay. Of course, the mechanic, if you don't have any cordial relationship with the mechanic, or you are not close to your personal mechanic, or you meet another mechanic outside to do the job, you have to pay that person. So if you don't have the cash at that moment, that means the car will be packed and it will be affecting your business operation. So that is why whenever you're making business decisions, you must first of all consider your cash, right? So this is where we are going to decide that. Now, if you look at here, if you look at under this, the working capital, we have the asset, and then under the asset, we have the inventory, we have the trade receivables, and we have the prepayment. Now, inventory, logistic company, what kind of inventory does logistic companies own? Now, the kind of logistic inventory they own, maybe they have those office equipment for printing of receipt, for stamping inks and other things, packaging equipment, packaging items. All these things are their inventory. Remember that they don't sell them, but they are actually things they use in generating revenue. On their own, they don't sell those things, but as clients comes in to make delivery, or they have to repackage those things. So they have to repackage those things in order to put them in a safer position for shipping. So they charge costs for all those things. So that is what constitutes the inventory for a logistic company, right? Some of the things that constitute the inventory for a logistic company, of course. Then we have the trade receivables. But logistic companies too have debtors. Of course, they have debtors. When you, in the course of your operations, you meet people that will patronize you often and often and often. So because you want to build that reputation with them, you want to build that trust with them, you can offer to render your services to them so that they can pay later. Of course, they will pay you later as the time progresses, right? So what you're saying is that how long, what the question we are trying to answer is, how long does it take our debtors to pay us? And we're saying that at most it should take them 30 days to pay us. It can be lower, right? It can be lower. Now let's take for instance your drivers are being paid, let's say weekly, and your debtors are paying you monthly. You can see there is no, that means you are paying more often than you receive. That is what it means. So that means if you're paying your drivers weekly, your debtor should be able to pay you every 5 days. At least you have 2 days interval before you can pay your drivers, right? In that condition, you won't have any need to lack cash. So that is what we are doing here with the assumptions we are trying to be. So we are saying that it should take our customers 30 days to repay us, right? So we have the prepayment, things you paid in advance, right? Things you paid in advance, right? So we have under the liability we have the trade receivable. Now you can see trade receivable, like I say, let's say for instance our drivers. Our drivers are like our trade receivables, but not necessary in light with the definition of what trade receivable is. Now, trade receivable are the vendors or people we buy from, or we buy those inventory items from, but we need to pay them back. Now, normally, because we don't receive money from our customers that are owing us every before, in fact, Normally, before you pay your debt, your creditors, you must have received money. So if you did not receive the money earlier on, how will you pay your debtors? How will you pay your creditors? That is why you have to receive your money earlier from your customers to be able to pay your vendors, to be able to pay your creditors. So that is why we say we receive our money in 30 days and we pay our credit and creditors in 40 days. I also have the accrual and other liabilities, right? So this is the assumptions we have built around the the logistics company. So you can just go ahead. Let me go ahead. In your own case, you have to type. So I will just copy this and paste it in our model here. Okay. When I paste it, just do Alt HVV. Then I will just format it. Place our input. Something is wrong here. I think I have changed this. I thought I have changed this. Thought I have changed this. So let me change this font quickly. I don't like the way the font is looking. So this is it. Let me change the font quickly. It's normal. Says modify font. This is what I want now. What I selected. Right. So that means I will have to do that on all the formats, the styles. Let me just do that quickly. Okay, let's go ahead and see input, modify. This is the font I want. Right, so I think that has been effected. Right, something like this. And that's now was seeing very, very big, as if I have eye problem. So we are done with our assumption. Now this is our assumption. We have completed our assumption. Now with this assumption, now it becomes more easier for us to build our model. Right, it becomes more easier for us to build our model, and the next thing we are going to build to order to be able to integrate everything to our financial statements is going to be the calculations. So some people build model, some people build their assumptions in one, they build the model, the entire model and the calculations on one table, on one sheet, while me, I prefer doing it on separate sheet because it becomes more, it is always easier for me uh, to trace back whenever there is an error or whenever there is an omission. Of course, it is not every time you prepare your model that it will balance at once. Sometimes after preparing the model, everything will, you have to go back. When you now go to your balance sheet, you realize that your balance sheet did not balance even after preparing the cash flow statement. So in that case, you have to go back and start tracing. And imagine if you are scrolling up and down just to look for where there is a problem. So that's why it is not always feasible for me personally. That's my opinion. It is not always feasible for me. I rather do it sheet by sheet the way I'm doing it. So right now I know that this sheet that I am on is called my input. That's my assumption sheet. So everything here that is going, everything you are seeing here is an assumption. There is no calculation here. Everything here is just an assumption. Where we have few calculations is just these places which we need to do, right? Which we need to do, but the the major calculations we're going to be doing is going to be here, right? So this is where we're going to do the major calculations. So when we return back, we will continue from where we stop. And again, if you are liking this video, if you are getting any value from this channel at all, please like, subscribe and turn on the notification button. And again, don't forget to share with your friends, share and tell them the good news that this channel is actually doing wonders. Like I said, this channel will give you everything you need in building financial model. the financial models we are building there, if you're interested in going into investment banking skill, you must have this skill for financial model. If you're interested in going into anything finance, right, understanding how to build financial models is going to be very, very important. And in this channel, I have dedicated myself to the point that I want to be building industry-based model, business-specific model. I don't want to just come and say, okay, how to build a two-statement financial model, how to do this, how to do it, without being specific to the kind of industry, to the kind of business that we are going to be building this model. That's why we started off with a general-based business, which is a distribution company. The first set of financial modeling class we did is, if you know what that, you can go back and watch. And this is now this is a logistic company financial model. It's actually very interesting. And I'm still coming on with others. In the one I'm developing now, I'm developing a real estate financial model and a project finance model. And also I'm developing a financial institution model. So all these things are knowledge I will be sharing on this channel. But you cannot, of course, get this knowledge if you're not subscribed to this channel. So kindly, please and please subscribe to the channel to help the channel grow and reach more people, right? Also share, right? So when we come back in the next class, we'll see how to integrate our assumptions into calculation. So if you have not subscribed, like again, I'm still begging you, I'm still begging. My knees are down actually. I'm still begging you, just please click the notification, click the subscribe button and like this video to show me that you're actually getting value. And also you can do me a favor, right? You can do me a favor by leaving a comment, if you are liking the video, if there's any value at all from this video, or if there's any observation you have made and you want to share it with me, kindly feel free, share it on the comment section. Again, if you need the file, just comment on the video that you need the file, then I will respond to you and I will tell you how to go about getting the file, right? So thank you very much and see you in the next section.